Everyone's downgrading their forecast. You actually upgrade yours. Mike, walk me through your thought process here.
Yeah, thanks, Alex, and good morning. Look, we're just kind of coming full circle to where we were. I guess at the beginning of the year, that was our original price target of 3,000. That came down a bit as the recession began. But then, look, we've been impressed, to be honest, with the reaction by the Fed, how aggressive they've been in intervening directly in the credit markets. And look, if there's one thing that we've learned in the last 10 years is that, in an era of financial repression, which we are clearly in, you've got to grab the risk premium when it appears. And in round numbers, we got to a 700 basis point equity risk premium on the S&P 500 back in March. That was comparable to what we got to in March of 2009, so very similar valuation. We've since come back down to about 500, but the normal equity risk premium is about 350 in the post-financial crisis period. And, it's not going to happen tomorrow because there's still a lot of uncertainty, but we think by year end, we could definitely get back down to those normal levels, and that would argue for a higher multiple given where rates are, about 19 times.
I was also struck by part of the call is an upgrade to small caps, the first time you're recommending the stock since July of 2018, even though they've just gotten totally creamed by the S&P, by earnings estimates, anything, you name it. Why?
Yeah, so, you're right. We've been underweight small caps for the last couple of years because typically as you end a business cycle, as you know, the small cap stocks struggle, and they have struggled. Just in last year alone, we had no earnings growth in the S&P 500, but small caps had negative earnings growth of 10, 11, 12%. So they've actually been in a bear market for quite a while. Now that we're moving into, a recovery stage at some point this year, typically small caps do better. So it's just a simple call on the business cycle, right? We've had the end of the cycle. We're in a recession, and so the next stage has got to be a recovery. And typically small mid caps lead on the way out. The second part of the call is related, once again, to policy, right? So policy response has been directed right at the small, medium businesses because that's where the jobs are and that's what the government wants to protect. So in some ways, the nature of this crisis is potentially going to lend a bigger helping hand to these small, mid-cap companies than they would normally get.
What we've also what people say you need to see to really get a bottom and then have a move higher is a rotation in leadership. What does that then mean for tech? Because many say, Netflix and Amazon, they're totally going to benefit from the virus. They're the ones that are going to be holding up. They're quote unquote recession proof. They have the cash. They're still deploying the capital, etc. What do you think?
Well, look, there are secular winners no matter what kind of a regime that we're in. Amazon's a perfect example. That's a name we've had on our fresh money buy list, our model portfolio, really since February, and we didn't anticipate this crisis. But clearly, they're showing their mettle that this is a winning kind of format, whether we're in a bull market or in a bear market. And so, I think there's some winners no matter what happens. However, as you point out, the big winners of the last cycle were secular growers, which includes a lot of tech companies. There's some wonderful companies in there. We like a lot of them, and we think they'll continue to do well. However, we do not think they're going to have the outsized performance that they had in the last cycle for a couple of reasons. A, we don't think interest rates can go much lower, which has been a big tailwind for long-duration growth stocks. And number two, once again, as you begin a new business cycle, the more cyclical parts of the market tend to do better because they have more operating leverage. And as you've been saying on the show this morning, they've been killed. And that's where the upside can come from. So it's not that the tech stocks can't go up. It's that they will just lag in the recovery, given that they are really a defensive, high-quality play.
So, Mike, then where does the leadership come from?
Well, I think it can come from two areas, and what we would qualify that as, we've been recommending a barbell. We think, high-quality stocks that have gone on sale, we want to be buying those, and we have been adding some of those over the last 2 or 3 weeks into our model portfolios. And then the other side, though, you need to start thinking about buying cyclical stocks, small caps being one of those, perhaps banks, which are in the news this week for having reporting numbers. Look, we have to go through this catharsis on the earnings. We knew the earnings were going to be poor for these cyclical names, but banks is an area, consumer discretionary, potentially pockets there that have been really beaten up some of the industrial areas and some of the even materials areas, right? So once again, early cycle stocks that tend to do better. So that barbell of high quality that's on sale, and then early cycle stocks that we think can make it through and have operating leverage to the recovery.
Final question here. What do you do with something like gold, or the utilities? And I mean just sort of this typical safe havens that we've seen. What do you do with stocks like that?
Well, we downgraded utilities a few weeks ago because it's been, it has been a big outperformer. It's been a great thing to own in, the last couple of years because we've been ending the cycle. And you could say the same things about other bond proxies. So those types of stocks we think could start to fade as the recovery becomes more evident. As far as gold goes, and things like gold that are inflationary plays, we think those are going to continue to get a bid. Gold is the easy one because it's clear that the central banks are printing money and people will want to buy gold stocks. But there are other inflationary plays, too, in the material space, maybe in the commodities area, in the banks, and such. So I would say gold and other inflationary hedges should continue to do better over the course of the next 6 or 12 months.